Hello, welcome everybody. Today I'm really honoured to have Benoit Ramsay from University of Cambridge Investment Office, and we want to talk about alternative investments today, Benoit. So when we think about alternative investments, I go back to 1949 when A.W. Jones created what was coined a hedge fund, where he used leverage to buy more shares in the market and did short selling on the other side to sort of neutralise the portfolio. So he believed he could make money in any market cycle. When you think about hedge funds today, do you still believe that definition holds true?
I think the the key selling point of a hedge fund remains the fact that it provides a return stream that's not very correlated, or certainly less correlated to the market than traditional assets. So I think that's true. I think obviously the industry has evolved significantly since that time. And I think the variety of strategies that people would bucket under the hedge fund umbrella has expanded pretty significantly. So the definition's been stretched, but I think at their core, hedge funds still seek to provide investors with a return stream or return on their capital that looks quite different to an investment in the stock market or bonds or anything like that.
So would you say, taking your sort of thoughts about that you would look for you said less correlated, would you look for more consistent a return as opposed to something that's like a long only strategy or, something in private equity?
Yeah, so I think the beauty of hedge funds and being a hedge fund investor is that you can use them as a tool to fit what you need in your portfolio. So I know a number of people in the industry who may use hedge funds to get very capital efficient or very leveraged exposure to a particular asset, which maybe a traditional asset may not be, and to provide quite a volatile return stream that they expect to make them a lot of money over time. And then you have other investors, and we fall at the University of Cambridge more into this camp, who try to use hedge funds to generate a steadier return stream that will pay its way in the portfolio, but will be there, or will be on a group of assets that will be there to allow you to redeploy that capital into traditional assets when those dislocate or sell off quite significantly. So because the hedge fund space is so diverse in terms of the underlying strategies and the different types of managers who run them, you can really use them for whatever purpose you would like as a institution that's trying to build a portfolio that works in lots of different kinds of market.
That's great. So I think most people who sort of enter the investment world, like many of our interns at Gain, will sort of think about investments and think about equities. But when we think about alternatives, there's other types of sort of asset classes and parts of the market that can be considered hedge fund strategies too. Could you sort of elaborate a bit more, perhaps, on say fixed income and credit and maybe relative value and other things like that maybe our audience might be able to learn from?
Yeah. So so just to say, obviously, that and you've sort of touched on it, that hedge funds is obviously just one area of the sort of alternative asset universe, and the major other alternative assets that people tend to allocate to today within their portfolios are private equity, other types of private strategy like private credit, privately managed real estate or other real assets, and also sort of very esoteric assets which don't necessarily fall in a particular bucket, like royalties from drugs or patents or things like that, which can be sort of packaged up and used to provide a return stream to investors. And then other things like commodities, or investments which are linked to commodities. Now, when it comes to hedge funds, themselves, they tend, although this isn't always the case, to invest mostly in asset classes that you would consider to be traditional asset classes, but they do it in quite a different way. So a large subset of them do invest in the equity market, as you said in the intro, going long stocks, but also going short stocks, where they think there may be an issue with the company, and you might expect the stock price to fall or the stock to fall in price. They also invest in debt issued by companies. They may do that on a standalone basis, or they may, for example, look at the same company and think, I actually really like the debt that's been issued by this company, but I don't think the equity is such good value, and they can go long one and short the other to play their view there. The other obviously major asset class that hedge funds tend to traffic in is government bonds. Again, traditionally a place that investors go to for safety, liquidity, to get a guaranteed return on their capital, which is relatively easy to calculate. But hedge funds use fixed income markets in a much more unconstrained way. So they will go long one particular bond or one particular type of instrument, short another, and try to, for example, monetize the relative value there. So they're really investing in the same underlying set of instruments or securities, be they bonds or stocks, but they're doing it in a more unconstrained way, using tools that might not be available to your typical traditional investor in those markets.
So when you think about hedge funds as part of an alternative universe, you've really elegantly explained that they're just one part of our overall universe. So for our GAIN audience here, when you take a portfolio like that at the University of Cambridge and other endowments, can you sort of explain asset allocation, i.e. investing in different asset classes, and how typically those endowments would allocate to alternatives and hedge funds as part of that versus the rest of a sort of traditional portfolio, so they can sort of have some idea about asset allocation, please?
Yeah, so the first thing to say, obviously, is that everyone has a different view on asset allocation and what the right asset allocation is for a particular institution or for a particular purpose. And the most important thing to bear in mind when you think about asset allocation is obviously what is the aim of your institution in terms of the return it wants to deliver in the long run, the risk it wants to take, how flexible the institution is in terms of allowing that portfolio to soak up capital for a very long period of time, or whether liquidity is required from that portfolio. So asset allocation should be derived as a function of that. But even when investors have quite similar views as to what they want their portfolio to achieve, institutions end up having quite different asset allocations. So I can only speak for us. At the very high level, we want to have an asset allocation that is relatively diverse, so that we're not reliant on one particular asset class or one particular economic factor to drive returns. And we would hope that diversification means that we provide a smoother return profile for our investors over time. In other words, for example, when equity markets sell off a lot, we may not realize such a significant fall in value. And alternative assets really play a big role in helping investors do that. So, for example, the University of Cambridge has about 65% of its portfolio in equity securities, but only about 2/3 of that is invested in the stock market through listed funds, and the other third, roughly, is invested in private markets through private equity managers. And the subset of companies that a typical private equity investor will invest in can be quite different to those companies which tend to be listed on equity markets. They have different tools to generate value, and and a different time frame over which they intend to generate value. So a private equity portfolio can provide, or is usually expected to provide, a higher return, but it is less liquid. Potentially there is more risk, depending on how you look at risk. And then the rest of the Cambridge portfolio is invested mostly in two other asset classes: real assets, which can provide a return stream that again is quite different to the return stream you might get in bonds or equities, which is often more linked to inflation or more hedged against inflation than other asset classes might be, certainly over particular time frames. And then lastly, we allocate significantly to hedge funds. As I mentioned, the driver behind our allocation to hedge funds is really about creating a relatively steady return stream, such that hedge fund portfolio can provide capital when it's needed to other parts of the portfolio, which may see bigger drawdowns in value over time. So that's how we think about asset allocation, but there's no right way necessarily to do so.
That's really great, and I think very clear. Can you sort of spend a couple of minutes explaining the different structures for alternatives versus non-alternatives? I know that's a vague question, but I think perhaps you very elegantly separated public markets and private markets. So if we can sort of explain the duration of each of those typically, and then how they're structured, and then things that you typically see in a public portfolio and things you typically see in a private portfolio. And I think to take that to a further level, we've now got hybrid funds which do both. So perhaps elaborate a little bit on those hybrid funds as well that have both publics and privates in them.
Yeah. Okay. So yeah, I'll focus on equities. So when it comes to public equity markets, clearly anyone can go on the internet, set up a stock trading account or a Hargreaves Lansdown account or something like that, and buy stocks listed in the UK or elsewhere in the world very easily and sell them very easily. And a lot of people invest in the stock market directly like that. We tend to invest through funds, which you mentioned, which are generally run by a portfolio manager who we see as having an advantage over the rest of the market for some particular reason, usually in some particular area of the market. So we invest with them on the basis that they will outperform the market or outperform some level of return we underwrite to. And so those sorts of structures really depend on the underlying strategy in terms of how they're constructed. But, often we will be providing our capital for half a year or 2 years to allow the portfolio manager to prosecute their strategy in the way that they need to. So, you can take quite liquid underlying things like listed equities and sort of turn them into more liquid things, but you have to have a good reason for doing that. Now, obviously, when it comes to private equity, it's much more difficult to just go and buy a private company. I mean, it's obviously something you can do, but obviously you generally have to buy the entire company. You need a lot more capital. It's much more labor intensive. So there we almost always use, or we exclusively use funds. And indeed, a lot of other investors of our size will use funds to gain access to those types of companies. And so generally there, as an investor in those funds, you're committing your capital for 10 plus years to ensure that the manager has time to buy a company, make changes within the company to improve it, hopefully, and then sell it again. And these processes take multiple years.
Great. So as we sort of come to the end of our chat, I wanted to sort of talk about where you see the opportunities in the future for not just your portfolio, but just generally for investors, alternatives versus non-alternatives, number one. And then do you think there are differences based on geography as well as just general opportunities in the markets?
Uh, Good question. I wish I had a crystal ball, obviously, but sadly we don't here. Um, what we do at Cambridge um, tends to be pretty consistent through a cycle. So we're not moving our capital very aggressively as a function of any perceived opportunity in the market. Usually, we do leave that to our managers to do on occasion. So it's not necessarily in my DNA to advise on great opportunities. I think on the hedge fund side, um, there there's been a huge amount of change in the industry in the last few years. I mean, for example, a lot of people used to allocate capital to um, one person and a team running a hedge fund, doing one specific type of strategy in a sort of niche context. And now the industry has shifted such that those managers still exist and are still thriving in many cases, but a lot of the biggest hedge funds are now staffed by multiple siloed teams of traders, and that can present challenges for investors. It can, it can bring great benefits as well. But the market's moved in that direction somewhat. I think if you're someone looking at the finance industry and thinking about going or trying to move into the hedge fund industry, um, that dynamic means that your career path is likely to be or may well be quite different to what it might have been 20 years ago. So people should bear that in mind. I would also say that the hedge fund industry is a place where performance is rewarded, good performance is rewarded, but it's not necessarily the easiest industry to build a steady career in because you're competing against lots of very smart people. There's a bit of luck involved, and really to garner the benefits of doing well, there needs to be more of a cutthroat attitude. So I would just bear that in mind when you're thinking about a future career. But it is an industry that is very meritocratic in that if you perform well, you're likely to do very well in your career. So it's not for everyone, but it's a really fascinating place to work. Just in terms of, I think on the hedge fund side, there are lots of opportunities for investors like us because the world is evolving and people who can look 4, 5, 6 years ahead, understand how markets are functioning, can generate outperformance in quite a consistent way. On the private equity side, that market has seen huge growth in the last 20 years, and much more competition. But again, we see reasons why investors in that market and people who work in that industry have the opportunity to continue to produce really great returns for their investors. So, generally, I have a very positive view of what the alternative asset space can bring, both for investors and people who are working or thinking about working in the industry.
Benoit, this has been really, really great. Any last final comments in terms of any young women hoping to get into the investment industry that you want to give that is not sort of industry related, just life related? Any final words of wisdom?
I think in the finance world, as I said, you have to have a reasonably thick skin, but that is not something that is something I think you can develop over time. And I think one of the most this doesn't apply to any type of person entering or thinking about entering into investment in particular, but what I found as super useful during my career is that the advice that basically you need to get really comfortable going out of your comfort zone from time to time and force yourself to do so. and I think that's particularly true in investment. Obviously, by definition, doing that um, is not particularly comfortable while you're doing it, but it does mean you'll develop more of a thick skin. It will bring you a new level of satisfaction in terms of what you get out of work, and it teaches you to basically fall flat on your face and pick yourself up again, which I think is something that will happen to everyone who works in investment, irrespective of how good they are at their job, because there's so much luck involved and patience involved, and it's pretty much impossible to go through your career without being, um, without failing multiple times. So I think that's what I would say, and just sort of go for it, basically.
Benoit, thank you so much. It's been so incredibly insightful and useful, and really appreciate your time. Thank you.
No problem, Rahul. Nice to see you.
Great. Becky?